Hey guys, John Thomas, Prime Residential Mortgage. Wanted to take a minute to just explain what's going on with the market, interest rates. There's a lot of misconception of what's happening. The Fed's lowering the Fed funds rate to 0%. Mortgage rates are going to be 0%. All this kind of craziness. There is no 0% mortgages. So I want to take a minute to explain what's going on. If you look at the chart on the screen right here, the Fed funds rate, this is a quick graph I grabbed showing the Fed funds rate back since 2001. Now, if you notice, from 2009 to 2015, the Fed funds rate was almost 0% the entire time. And mortgage rates were not 0%. They're actually higher than they were now. So why someone thinks the Fed lowering the Fed funds rate back to zero where it was for, from 2009 to 2015, why would that make interest rates go to zero? I have no idea. It's not going to. The Fed funds rate is the overnight lending rate that the Feds have for banks. They're lowering that rate so the banks can borrow money between each other and the Feds to keep their balance sheets healthy, because what they're worried about is a run on the banks because of the coronavirus. The banks, if there's a run, don't have all the money. Now, if depositors want their money back, they either have to have the money and give it to them, which they don't, or they're going to have to sell assets at a discount to get the money back. So by lowering this rate, they can go to a bank or the Fed, borrow the money, pay the depositors, so there's no run on the bank. They're also going to allow them to sell their treasuries, any of them that they're holding, to get cash to pay depositors. So basically, they're injecting liquidity into the market by lowering the Fed funds rate so that if there's a run on banks, they're not going to run out of money. It's not going to cause a financial panic because of this virus issue. So the Fed funds rate does not directly impact mortgage rates. What impacts mortgage rates is mortgage bonds. So if the price of bonds are going up, the yield, the interest rates go down. If the price of the bond goes down, the yield or the interest rate goes up. So if we take a look at what's going on in the bond market, that affects interest rates, but you also have supply and demand coming in. So the lowest interest rate we saw ever was Monday, back on March 9th. That's when the bond hit the lowest it ever been. Didn't stay there long. It actually turned into a giant sell-off, and then it sold off the rest of the week and didn't find a bottom until Friday. So as the news is saying interest rates are all-time record low, they actually were completely wrong. Rates had moved up almost a whole 1% from the record lows last week. And part of that was two reasons: the bond selling off and mortgage banks just raising rates to stop loans coming in. The mortgage banks are all at capacity. They have more loans that came in such a short period of time. They don't even know how they're going to close the loans they got, so they really don't even want any new loans. Most banks have stopped the refis altogether just so they have enough capacity to even close the purchases that might come in. So it's supply and demand. If you've got all these people that want mortgages and you've only got this much capacity, you raise the rates to try and slow the income of new loans to give you a chance to clear out all the loans you already got. Consumers don't understand this, so they expect mortgage rates to be low. They're not. They're about 1% higher than they were before. You've got banks that just aren't, there's no incentive for them to match the bond, because the bond did rally today as the stock market sold off. And the reason mortgage bonds rallied was not because the Feds cut the Fed funds rate. They actually wouldn't have moved because of that. They moved because the Feds, in their statement last night, said they're actually going to buy $200 billion worth of mortgage bonds every month. And they're started today. They're buying $500 billion of treasuries starting today each month. So that pumped liquidity into the bond market and the treasury market. And that was part of the problem for mortgage bonds, is nobody wanted to buy them. And the banks, if you make a new loan and no one's going to buy the loan, the only way you can make the loan is to serve it yourself. And if you service loans, you got to have a ton of cash. So banks didn't have the cash to service all the loans that were coming in, and there's nobody buying them. So they're in a quandary. So what do? You raise rates. So this has helped the bond market, but you still got the capacity issue. The bond rallying is not fixing the capacity issue. Banks literally don't have the capacity to close loans. Now, I see this getting better. So if you're looking to refinance, I would recommend getting an analysis done, get your loan set up. I think about April, you might see the refinance rates come back to where they make sense, because hopefully some of this capacity issue is getting blown out through March. But that's not going to last long. If it comes back, you better be ready to go, because you probably got a week, and then all these refinances flux in. Lenders do the same thing again, raise the rates because they hit the capacity issue real fast. There's $11 trillion or so worth of mortgages out there. I think what I heard was about $5 trillion could benefit from a refinance when the rates were low. The best that we could hope to close an entire year with the banking system we have is $3 trillion. So that's not even going to make it, we got $5 trillion that could benefit from a refi. Now, that's not going to mention the purchase business, or at least another $1 trillion of purchase business. So we've got a capacity issue. So the most important thing right now is not rate. It's can a bank even close your loan? So if you have questions, if you need a free analysis to get yourself set up for a refinance that might be there in April, certainly let me know. If you're trying to do purchases, my bank is prioritizing purchases. We're still closing them right now in 30 to 45 days, depending on the loan. Now, can that go on forever? I doubt it. If we're going to run into a capacity issue as well at some point. So the more of the story is get your contract, get your application, get your loan locked, get into processing, and get going on the purchases. The refis, get set up, get okay with the rate, and then be on alert as soon as it comes back. Lock and go. You can't think about it because the people that thought about it came back a week later, the rate was gone. So if you got questions, 302-703-0727 is my office number. Email me, jthomas@primeres.com. Find me online, DelawareMortgageLoans.net. I'm licensed in Maryland, Delaware, PA, New Jersey, and Virginia, so would love to help you out. Have a great day.